Today we're going to look at the company Shandong Weigao Group, headquartered in China and traded on OTC markets under the ticker SHWGF. Please stay tuned for the important disclosure information at the conclusion of this video. Shandong Weigao Group traces its origins back to 1988, when it was founded by Chun Xueli in the coastal city of Weihai, Shandong Province. Initially operating as the Weihai state-owned medical apparatus factory first branch, the company began its journey with a humble focus on producing disposable sterile infusion sets. This early specialization in medical consumables laid the groundwork for what would become one of China's most significant healthcare enterprises. The turn of the millennium marked a transformative phase for the organization. In December 2000, Shandong Weigao Group Medical Polymer Company Limited was formally established as a joint stock company to better position itself for international expansion and capital market access. This strategic restructuring bore fruit on February 27, 2004, when the company successfully listed its H shares on the growth enterprise market of the Hong Kong Stock Exchange. Seeking even greater visibility and liquidity, the company later successfully transferred its listing to the main board of the exchange in 2010. Throughout its history, Weigao has aggressively diversified its portfolio, moving beyond basic disposables into high-value sectors such as orthopedic implants, blood purification, and interventional tools. A major turning point occurred in 2007 through a significant alliance with Medtronic, which accelerated the group's technological integration and global reach. Further solidified by international acquisitions, such as Argonne Medical in 2017, the company has evolved into a global player that now serves thousands of healthcare organizations and exports to over 100 countries. Shandong Weigao Group operates a diversified, vertically integrated business model focused on the research, development, and high-volume manufacturing of medical devices and pharmaceutical packaging. The company is organized into several primary business divisions: medical device products, orthopedic products, pharma packaging products, blood management products, and other. This structure allows the group to provide a comprehensive suite of healthcare solutions, ranging from high-volume clinical care consumables like syringes and infusion sets to high-tech surgical robots and orthopedic implants. The group employs a strictly institutional B2B sales strategy, primarily targeting top-tier hospitals, blood stations, and medical distributors rather than individual consumers. By maintaining an extensive domestic network of over 100 municipal representative offices across China, Weigao has secured a presence in nearly 4,000 hospitals and hundreds of blood stations nationwide. This localized sales force is essential for navigating China's complex public procurement and bidding systems while providing direct technical support to clinical staff. While China remains its core market, Weigao has aggressively pursued international expansion, with overseas revenue now accounting for approximately 26% of its total turnover. The company exports to over 100 countries, with key regional hubs in the United States, the European Union, Southeast Asia, and Brazil. This global reach is bolstered by strategic international acquisitions, such as Argonne Medical and RadSource, which provide both established sales channels and advanced manufacturing platforms in Western markets. The financial history of Shandong Weigao Group over the last 2 decades tracks a remarkable transformation from a specialized local manufacturer into a global healthcare titan. In the early 2000s, the company focused on building a dominant position in China's basic medical consumables market. This foundational era saw the 1 billion revenue mark in 2007. By providing the essential building blocks of hospital care, such as syringes and infusion sets, Weigao established the massive distribution network and clinical reputation that would fuel its next phase of growth. As the 2010s unfolded, the company pivoted toward high-value diversification. The acquisition of Argonne Medical intensified focus on orthopedic implants and pharmaceutical packaging began to significantly alter the revenue mix. This transition is reflected in the jump from 7.5 billion Hong Kong dollars in 2017 to over 10 billion in 2018. This period marked Weigao's successful move up the value chain, where higher technical barriers allowed for better margins and protected the group from the increasing competition in low-end plastic medical products. The peak of this growth trajectory occurred in 2021, when total revenue hit a record $16.2 billion. This surge was driven by the global demands of the pandemic and the company's ability to supply critical consumables and vaccine packaging at a massive scale. However, the years following this peak illustrate a new reality of regulatory maturity. The full implementation of China's volume-based procurement policy forced a significant reset in domestic pricing, leading to the revenue contractions seen in 2023 and 2024. By 2025, the group has successfully demonstrated its resilience, with revenue stabilizing and recovering to $14.8 billion. This turnaround indicates that the group has largely absorbed the initial shock of domestic price cuts. Today, Weigao is finding growth through its international divisions and its leadership in high-tech niches like interventional tools and pre-filled syringes. This evolution from a volume-driven manufacturer to a technology-driven global partner defines the current state of the company as it enters its third decade of public operation. The financial architecture of Shandong Weigao Group over the past 20 years reveals a company that has successfully navigated the transition from a specialized Chinese factory into a diversified multinational healthcare partner. In the earliest years of this analysis, from 2006 to 2010, the company operated with high capital efficiency, maintaining lean research and development budgets while dominating the domestic market for low-tech medical consumables. During this phase, revenue grew from under 1 billion Hong Kong dollars to nearly 3 billion, largely driven by the volume requirements of China's expanding public health system. Operating cash flow during these early years was remarkably strong relative to revenue, as the company benefited from significant scale and relatively low competitive price pressure. As the 2010s progressed, the group began a deliberate shift toward high-value diversification. The increasing allocation to research and development, which grew from just $0.2 billion in 2011 to $0.7 billion by the 2023, underscores a commitment to moving up the medical value chain. This era saw the introduction of orthopedic implants, blood purification systems, and sophisticated interventional tools. The acquisition of Argonne Medical in late 2017 to 2018 was a watershed moment, fundamentally altering the group's financial profile. This transition is evident in the revenue surge between 2017 and 2018, where turnover jumped from $7 billion to $10 billion. However, this growth came with increased operational complexity, reflected in the rising sales, general and administrative expenses as the company built out a more specialized global sales force. The other row in this table serves as a critical reconciliation point between total revenue and operating cash flow. In the financial reporting of medical device companies like Weigao, this row often accounts for fluctuations in working capital, specifically accounts receivable and inventory levels, as well as non-cash adjustments such as depreciation and amortization. The implementation of China's volume-based procurement policy in the early 2020s represented the most significant regulatory hurdle in the company's history. By mandating aggressive price cuts for high-volume hospital supplies, the policy put significant pressure on the medical devices and orthopedics segments. This is clearly visible in the revenue dip from the $16.2 billion peak in 2021 to the $14 billion reported in 2024. Despite this top-line pressure, Weigao's operating cash flow has remained resilient, staying $3.0 billion. This resilience is a direct result of the company's cost control measures and its pivot toward the pharma packaging division. Capital expenditure has followed a strategic arc, peaking during the high-growth and expansion years of the late 2010s as the company built out state-of-the-art manufacturing facilities in Weihai and integrated international production sites. In the last 3 fiscal years, CapEx has begun to normalize as the group shifts focus from physical capacity expansion to digital transformation and R&D-driven product launches. This moderation in spending has allowed the group to maintain a healthy free cash flow, which stood at $2.2 billion in 2025. When accounting for stock-based compensation, which remains a relatively minor portion of the group's total expense profile compared to Western tech firms, the true free cash flow remains robust, providing the group with the liquidity necessary for further strategic acquisitions or dividend payments. Today, Shandong Weigao stands as a model of adaptability. While the domestic Chinese market remains its cornerstone, the company's 2025 results signal a new normal, where growth is no longer driven by simple volume, but by the technological sophistication of its interventional platforms and its expanding footprint in the United States and Europe. The financial data highlights a group that has moved beyond the consumables tag, evolving into a resilient medtech entity capable of generating consistent cash flows even in a strictly regulated domestic environment. The multi-decade financial narrative of Shandong Weigao Group is a study in disciplined capital management amidst a rapidly shifting Chinese regulatory landscape. In the first decade of this study, spanning from 2006 to 2016, the company operated as a cash-generating engine within the domestic market. During this foundational period, Weigao focused on maintaining a highly liquid balance sheet, as evidenced by the steady accumulation of cash and short-term investments, which grew from a modest 0.4 billion Hong Kong dollars to nearly 5 billion by 2016. This phase was characterized by organic growth with conservative returns, where the company utilized its free cash flow to provide consistent, gradually increasing dividends while keeping debt levels low and avoiding transformative acquisitions. The conservative debt-to-equity profile during these years allowed the group to build the dry powder necessary for its future global ambitions. The group's capital allocation strategy underwent a fundamental shift in 2017 with the acquisition of Argon Medical. This single transaction, valued at approximately 6.6 billion, marked the first major deployment of the group's accumulated capital and its first significant use of external financing. The financing debt row reflects this pivot, jumping from 1.3 billion in 2016 to 6.8 billion in 2017. This strategic move was not just an expansion of scale, but a deliberate attempt to diversify revenue streams away from domestic products that were beginning to face price pressure. The Argon acquisition provided Weigao with an established international platform and high-tech interventional products, which have since become the group's primary hedge against domestic regulatory volatility. Following this international expansion, the years between 2018 and 2021 represent a period of high-performance consolidation. Boosted by the global demands of the pandemic, the group's true free cash flow reached record highs, peaking at 2.4 billion in 2021. This era saw the company rewarding shareholders more aggressively through both dividends and its first meaningful share repurchase programs. Despite the increased payouts, the company managed to systematically reduce the debt incurred from the Argon acquisition, bringing financing debt back down below 5 billion by 2021. This deleveraging while distributing strategy showcased the underlying strength of the group's diversified business segments, particularly pharma packaging, which provided high-margin stability. Shandong Weigao Group is currently led by Rainan Song, who has served as the Chief Executive Officer and Executive Director since March 2021. Mr. Tsong is a veteran of the organization, having risen through the ranks over many years. Notably, he previously held key leadership roles as the General Manager of the Clinical Care Business Unit and as Deputy General Manager of the entire company. His deep operational expertise is reflected in his compensation structure, which for the most recent fiscal year included a base salary of approximately 1 million Chinese yuan renminbi and a total annual compensation package of 4 million Chinese yuan renminbi. The ownership structure of the company is characterized by a strong concentration of private holdings alongside significant institutional participation. The largest single shareholder is Weihai Weigao International Medical Investment Holdings Limited, a private entity that controls approximately 46% of the shares. Institutional investors collectively own about 34% of the company. The remaining 20% is held by the general public. This mix ensures a stable core of long-term private control supported by the oversight and liquidity provided by world-class institutional and public shareholders. The liquidation value is estimated at 4.4 billion Hong Kong dollars, or 13 cents per share. Let's build a scenario-based dividend discount model. The bull case for Weigao envisions a future where the company successfully sheds its low-end manufacturer label to become a global medtech titan. In this story, the primary catalyst is the hypergrowth of the pharma packaging and interventional divisions. By dominating the global supply of pre-filled syringes for the booming biologics and GLP-1 markets, Weigao manages to effectively bypass the domestic price caps of China's volume-based procurement system. Furthermore, this scenario assumes that the group's internal restructuring and surgical robot launches achieve significant market share in Europe and Southeast Asia. Revenue growth remains robust, and the resulting high-margin cash flows allow the company to reward shareholders with double-digit dividend growth and aggressive share buybacks, funded by a globalized revenue base that is largely immune to single-country regulatory shifts. The base case assumes a path of steady, managed transformation where Weigao remains the national champion of Chinese medical devices while slowly chipping away at international markets. The story here is one of resilience. The company uses its massive domestic manufacturing scale to maintain leadership in China despite thin margins caused by VBP. The catalysts for this case are the continued aging population in China and a gradual increase in international sales, which eventually reach 40% of total revenue. Growth is steady, and while operating margins don't reach the heights of the bull case, they remain healthy enough to support consistent dividend increases and tactical bolt-on acquisitions. This is a story of a company that survives the commodity trap by being the most efficient producer in the world, slowly moving up the value chain through incremental R&D rather than explosive breakthroughs. In the bear case, Weigao finds itself caught in a pincer movement between domestic price erosion and international geopolitical barriers. In this narrative, VBP price cuts expand to cover even the most sophisticated orthopedic and interventional products, essentially turning high-tech medical tools into low-margin commodities. Simultaneously, Western protectionism or increased competition from emerging markets prevents Weigao from scaling its international business effectively. Revenue growth slows, barely outpacing inflation, and operating cash flow margins compress as the company is forced to compete solely on price. In this environment, capital is preserved for basic operations, leading to stagnant dividends and a complete halt to stock repurchases, as the group focuses on surviving a low-margin, high-regulation domestic landscape with limited room for error. In the bull case scenario, we assume the following: revenue growth at 9.5%, operating cash flow margin at 26%, capex growth at 5%, stock-based comp growth at 8%, dividends growth at 14%, stock repurchase at 12%, acquisition spending in the next 20 years at 25 billion Hong Kong dollars. Stock repurchases assumes price-to-sales ratio of 2. With this discounted at 7.5%, dividend model yields 83 cents worth of value per share in 20 years, $1.81 in 30 years, and $3.62 in 40 years. In the base case scenario, we assume the following: revenue growth at 6%, operating cash flow margin at 20%, capex growth at 3.5%, stock-based comp growth at 4%, dividends growth at 8.7%, stock repurchase growth at 4%, acquisition spending in the next 20 years at 12 billion Hong Kong dollars. Stock repurchases assumes price-to-sales ratio of 2. With this discounted at 7.5%, dividend model yields 47 cents worth of value per share in 20 years, 76 cents in 30 years, and $1.08 in 40 years. In the bear case scenario, we assume the following: revenue growth at 2.5%, operating cash flow margin at 16%, capex growth at 1%, stock-based comp growth at 2%, dividends growth at 4.9%, stock repurchase growth at 0%, acquisition spending in the next 20 years at 5 billion Hong Kong dollars. Stock repurchases assumes price-to-sales ratio of 2. With this discounted at 7.5%, dividend model yields 33 cents worth of value per share in 20 years, 44 cents in 30 years, and 60 cents in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.